All right, today we're cracking open the latest quarterly results from investment giant Rowe Price. And honestly, on the surface, the numbers tell this really fascinating, almost contradictory story. But when you dig a little deeper, you start to see a company making some absolutely massive strategic moves.
So here's how we're going to break it all down. First up, we'll look at the headline numbers and the weird paradox they create. Then, we're going to check their investment report card, see what's working and what's not. After that, we'll unpack a huge new partnership with Goldman Sachs. Then, we'll explore their push into new frontiers like ETFs and crypto. And finally, we'll look at how they're running a tighter ship to fund this whole new chapter.
Okay, so let's jump right in with the big picture financial performance. At first glance, you see two key numbers from this quarter that seem to completely contradict each other. It's almost like you're looking at two different companies at the same time.
On one hand, Rowe Price just hit an all-time high. They are now managing a staggering $1.77 trillion for their clients. That's more money than they have ever managed in their entire history. It's a huge, huge milestone.
But here's the twist. During that exact same record-setting quarter, clients actually pulled a net $7.9 billion out of the firm. So the total pot of money got bigger, but the flow of money from clients was actually negative.
So how is that even possible, right? Well, the simple answer is that the markets were on a tear. The investments they were already managing grew so much in value that it completely papered over the money clients were withdrawing. It's a real financial puzzle, and it kind of sets the stage for everything else we're about to talk about.
And that puzzle leads us right to their investment performance. How are their funds actually doing? Well, just like those headline numbers, it's a story of both strength and struggle.
Okay, so on the good side, their long-term track record, still really solid. Over half their funds are beating their peers over 3, 5, and 10-year periods. And their bond funds in particular are doing exceptionally well. The challenge, though, is in the short term, especially with their U.S. stock funds. That's where they're seeing most of the money walk out the door.
So you have to ask, why the struggle with stocks? Well, the company's head of global investments, Eric Viel, put it pretty bluntly. He talked about a very narrow market. Basically one where just a few giant tech stocks are driving all the returns. He says Rowe's classic focus on quality and value just hasn't been rewarded lately. It's a very candid admission that their time-tested style is facing some serious headwinds right now.
But here's the thing. Rowe Price is not just sitting around waiting for the wind to change. And that brings us to what is easily the biggest news of the quarter, a really game-changing collaboration with another Wall Street giant, Goldman Sachs.
And let me be clear, this isn't some minor product launch. This is a major team-up with Goldman Sachs. Their goal is to create a whole new suite of investment solutions, and they're really aiming them at retirement and wealth investors.
This partnership is really focused on 4 key areas. They're going to create co-branded retirement funds, develop model portfolios for financial advisors to use, build new products that mix public and private investments, and use Goldman's tech to offer personalized advice on a massive scale.
Now, a huge piece of this whole puzzle is something called alternatives. So what are they? Basically, think of any asset that isn't a typical stock or bond. Things like private credit, for example. The whole idea is to give everyday retirement savers access to these more complex investments, hoping to diversify their money and maybe even boost their long-term returns.
And Rowe Price has massive ambitions for this thing. When the CEO, Rob Sharps, was asked about the potential, he did not mince words. He's not thinking small scale here. He basically said he believes this collaboration can bring in way more than just a couple of $1 billion. So the takeaway is, this is a major strategic bet for them.
But that Goldman partnership isn't their only big move. The company is also pushing, and pushing hard, into 2 of the hottest areas in finance today: exchange-traded funds, or ETFs, and, yeah, even cryptocurrency.
First off, their ETF business is absolutely blowing up. They now have $19 billion in ETF assets under management, and they brought in nearly $2 billion of new client money into these things just in the last quarter. That's some serious momentum.
And they have a really clear plan to keep that fire burning. Get this, they've doubled their market share in active ETFs for 2 years straight. They're investing in specialized sales teams. And they plan to launch enough new ETFs to cover over 3/4 of the entire investment landscape by 2026. They are going all in on this. Okay, but maybe the most surprising move for a firm this traditional is this. They are officially entering the crypto space.
And they're not just dipping a toe in either. They've been quietly building their own internal crypto team since 2022 and have now filed for an ETF that holds multiple cryptocurrencies.
They see digital assets as an important future building block for investor portfolios, and they're trying to position themselves as a trusted guide in this really new and emerging world.
Now, all of these ambitious plans, the Goldman deal, the big ETF push, the crypto venture, they all cost money. So how are they going to fund it all? Well, that brings us to our final section, running a tighter ship. To free up resources, the company has been getting really focused on efficiency. And the most visible result of that is a 4% reduction in their total number of employees since the start of the year.
This is all part of a much bigger expense management program. They're eliminating roles, they're outsourcing some of their tech functions, and they're even shrinking their physical real estate by getting out of 2 buildings on their main campus. The whole goal is to keep expense growth really, really low for the next couple of years.
But the CEO, Rob Sharps, is really clear that this isn't just about cutting costs for the sake of cutting costs. He calls it a very purposeful strategy. The idea is to drive efficiency so they can reallocate those resources and pour them right back into those big strategic bets we just talked about. It's about funding the future.
So to wrap it all up, what have we got here? We have a legacy investment firm facing some very real challenges. Clients pulling money in a tough market for their style. And in response, they are making some bold strategic pivots. They're partnering with Goldman to get into alternatives, they're aggressively expanding into ETFs and crypto, and they're streamlining the whole operation to pay for it all. And that, of course, leaves us with the big question. T. Rowe Price is clearly not sitting on its hands. It's actively trying to reshape its business for a completely new era of investing. But will these bold moves be enough to navigate the massive shifts in the industry and actually win the future? I guess only time will tell.